Before we delve into the power of mutual fund, would you please advise why we invest in the first place?
As you rightly said, before going into building wealth with the power of mutual funds, let's see why to invest. At the outset, what is investing? Investing is purchasing an asset which preserve and also increase the value of money which was deployed over time. So investing is basically to preserve the value of money in different assets. So we have to deploy the money so that the value is preserved first, then it grows. So basically investing is to preserve and grow. So if you ask me the reasons, there are many reasons to invest for the investors to invest, and I would suggest there are three most important reasons. First one is investing for the future. So imagine your older self. The first thing comes to mind when you are imagining yourself as your older self. The first thing comes to in your mind is retirement. If you take history till 18th century of till end of 18th century or exactly 1889, there was no concept of retirement. All had to work till their last day of their life to survive. Only in 1889, then the Chancellor of Germany, Otto von Bismarck, brought in a government-backed retirement system for people above 70 years, and it spread globally thereafter. The reason given by Bismarck for why he has brought in a retirement scheme for the people, he said people who are not able to continue to work have the right to claim on the government for the living. So it is not that everybody have a government-backed investment or the retirement plan in India. So it is mandatory for us, for the investors or the normal person, to keep a financial backup as a retirement planning. So this is the first important reason. Also, there is an increase in lifespan. Due to modern technologies and development in medicine, the lifespan of human race increased considerably during 19th and 20th centuries, which second important reason for people to invest is preserve the value of money against inflation. Declining value of any currency is the most important reason also for us. Inflation is an invisible tax paid by all without realizing the destructive attack on value of currency. A study says mere 2% annual inflation will off the value of currency in 34 years. And 3% inflation will make it in 23 years, and 4% will make it in 17 years. The 5% will make it sometime in, it is in 14 years. The currency value will get into off. Suppose we have a 8% annual inflation, that makes the value of currency off in 5 years. That is, in every 5 years, the essential commodities and life items are going to double. Preservation of value of money is more important and demanding to counteract the effect of or the attack of inflation. So the third reason I was mentioning is like to replace the human capital with financial capital. Human capital is a value of one's skill, knowledge, and time. The skill and knowledge might be increasing as we grow older, but time will not. So we all need to compensate the loss of human capital with the financial capital by investing.
Thanks for the wonderful fact, sir. It was amazing. Having understand the importance of investing, what are the investment options do investors have?
As you mentioned in the initial introduction itself, there are many avenues for us to invest in the technological era for us now. Starting from, say, small saving schemes like Public Provident Fund, National Savings Certificate, and the Post Office savings schemes, then corporate as well as bank deposits, stocks, bonds, and commodities like gold, silver, crude, and many more. Investing in mutual fund is an important vehicle for wealth creation to invest either in one or more of these avenues.
Thanks for the wonderful facts you shared about the investing. Having understood the importance of investment, what are the investments available for the common investors?
As you have informed in the introduction itself, there are many avenues in the technological era, starting with small saving investments like public provident fund, national saving certificates, and post office saving schemes, fixed deposits by the corporates, banks, and non-banking financial institutions (NBFCs), real estate related investments, stocks, bonds, commodities like gold, silver, and crude, and even for the chana and dal. There are many commodities to invest, and bonds, debentures of corporates are always available. So investing in mutual fund is an important vehicle to invest in one or more of these avenues. Investment through mutual fund itself is not alone. Investment in through mutual fund is done all these investment avenues. It may be in bonds or stocks or commodities or anything in between.
Okay, thank you. On a layman level, how do you describe mutual fund? How does it operate?
Now that we have seen what is investing and why to invest, we can move on to the question of why to invest in mutual funds. Okay. First, what is mutual fund? Mutual fund is a type of investment vehicle in which money from many investors who share a common investment objective are pulled together and invested in the share market or any other avenues available for the fund manager to make a return in the long run. Now that we have seen what is investing and why to invest, we can move on to the question of why to invest in mutual funds in particular. But first, what is mutual fund? Mutual fund is a investment vehicle in which money from many investors who share a common investment objective is pulled together and given to an experienced fund manager to invest in the share markets to take advantage of the stock markets and its regulations. The structure of mutual fund is three-tiered. There is a sponsor who registers the mutual fund as a trust. In turn, he appoints trustees and asset management companies to protect the interest of the unit holders, that is the investors, and to launch and manage the asset of the mutual fund schemes respectively. The organized framework ensures the professional management and the investor protection through clearly defined roles. The AMCs are responsible for the running of the mutual fund schemes. Okay. They launch the new mutual fund schemes in the market called the new fund offer and give the investor a chance to invest, collect the money.
We are talking about the several avenues of investing. Why do we need to invest in mutual funds?
From my experience, investing in mutual fund is better than investing in any other assets. There are many reasons. I will only give the top reasons why we have to invest in mutual fund. For all the asset classes, excepting the fixed deposits with the NBSC or the banks or the corporate deposits, the asset owner need to find a buyer when you need to sell the assets. The market or stock exchanges are not responsible finding a buyer for the asset. The stock exchanges may only match the buyer and seller if they are available at the same point of time. On the other hand, the mutual fund buys the units from the investor at any point of time at the current NAV. This is called mutual fund redemption. The second one is real estate investments. The most important need in the real estate or land related investment is safety. Moreover, it lacks liquidity. Whenever a real estate or land related investments are disposed or liquidated, it's always a distress sale. We don't get the market price. Market price, I mean, here is the same price, the price we have to pay. Suppose we have to buy the same property there. The buying price or the selling price, always different. We don't get the market price in that sense. Bank deposits, on the other hand, are well regulated by RBI and the returns are taxable, excepting the NRE deposits.
Okay. How can mutual funds be one upon the various avenues for a lay investor?
The most important attributes to make mutual funds stand apart as a powerful vehicles of wealth creation are professional management. Mutual fund investments are managed by experienced and professional qualified fund managers with the backing of team of fundamental and technical equity research analysts who are having an eye on the individual stocks in the portfolio and overall industry trends and economic outlook. They have deep knowledge in the financial markets and strive to generate returns over the long time. The problem with purchasing individual stock is the investor always buy a particular stock based on word of mouth, either from friend, relative, or stockbroker. It is very rare the investor purchasing a particular stock based on an investment strategy. The individual stock investment or the investor need to be alert all the time, and he need a lot of time to do the research if they want to be an expert in individual stock picking. Mutual fund investment does away with this requirement. We have experts to do the job. And the next point is diversification. Mutual fund investments are made by purchasing variety of assets like stocks, bonds, government securities, etc. By investing in a diversified scheme, the risk is reduced as it is spread across many investors and many assets classes like stocks, bonds, diamond securities, and any other multiple factors are there. Next one is transparency. The investor gets regular information on the value of investment, the fund manager's outlook on the industry as well as economy, and the any updates required for the investor to always you get an update from the asset management company. Affordability next. The investor can have an interest in a basket of stocks, bonds by investing a small amount, say 5,000. Nowadays, there are asset management companies who are offering very low investment threshold, like 500 rupees for a SIP and 100 rupees for a lump sum. So that makes mutual fund affordable to each and everybody in India. And impartiality next. It does not matter whether the investor has invested 100 rupees or 100 crore in the mutual fund. The investor is getting same fund manager, same market access, and same portfolio. There is no partiality here is a big investor or small investor. The treatment is same. And liquidity, as told earlier, the investors can encash their holdings at any point of their investment journey. The asset management will buy the units at any point at the current NAV, and payment will reach the account of the investor within 2 working days. So investment in mutual fund is like almost having a bank account and exposing the money in the account to the market related growth, of course with associated risk. Then next comes the suitability. Mutual fund schemes to suit the needs of the investors based on their financial objectives, such as retirement planning, purchasing a house, children education, or any other life events. So mutual funds offer a wide choice of schemes to suit the varying needs of the investor during their life. Mutual funds cater to the investors with varied risk appetites. Equity funds with potential for high returns will be best suited for investors with focus on growth, while investors prone to stability might go to the debt funds, with investors focused on moderate returns going in for hybrid or balance. The level of aggressiveness will determine which sort of funds we are investing, whether it's small cap, mid cap, flexi cap, or multi cap, or complete debt fund. So then convenience. The investor need not micromanage his portfolio on his own. It reduces the paperwork for him. Also, it helps him to avoid several problems such as delayed payments, follow up with banks, companies. So the investor saves time, one part. Besides, you don't need to time the market, whether the market is up or down. We have designated experts to take care of. So economical. Investments in mutual funds is more economical as the cost is always spread across many investors. And the format of mutual fund itself has a cost advantage due to a huge amount of transactions. So well regulated. All the mutual fund houses function under the purview of SEBI, Securities and Exchange Board of India, which is the government agency that supervises the mutual fund industry and works to safeguard the interests of the investors. A close check by a government agency always ensures transparency in the operations of the mutual fund.
That's a wonderful mechanism. So investors, amateur investors who's gonna invest in the mutual fund, the funds are secure and they can withdraw the amount on timely manner if it is needed. We'll move on to the next question. Um, as we understand, mutual fund investments are little concerned. They do also have some risk and disadvantages. Can you elaborate on that?
Yeah, first, the mutual fund investments, even though I mentioned it's like a bank deposit exposed to the market risk, the mutual fund investments are subject to market risk at any point of time, and the returns are not guaranteed. As per SEBI rules, no fund house or any AMC should guarantee the investment of any mutual scheme. It is always subject to market risk. Market going up, down, it's always the investors is also. But over the long time, say 3 to 5 years and above, the short-term market volatility gets smoothened out, leading to more stable growth. By harnessing the power of compounding, you can turn relatively small investment into a substantial corpus in the over a time. Second, the mutual funds comes with a cost. It's not free. The fund management company, the AMC need to survive. Okay, but SEBI has imposed a cap on how much expenses can be charged to a mutual fund scheme by AMC. Also, the third point is like tailor-made portfolios are not possible in the case of mutual funds, but investors can invest in funds with asset allocation that matches their return expectation and risk tolerance to attain their goals. Several investors first find it difficult to go through and select the correct fund from the plethora of funds. There are many funds available. The normal investors may find it intimidating to select a particular fund well suited for them. In this case, the investors can take advice from the mutual fund distributors or investment advisors who are all qualified and certified by AMFI. AMFI is the Association of Mutual Funds in India. The advantages offered by mutual funds outweigh the disadvantages, and we have an antidote for each.
Uh, Mutual fund offers a powerful tool for building long-term wealth. Talking about the power of compounding, how can it help achieve goals of the every individual?
The term compounding in the investment world is synonymous with time for the future goals like education, retirement, etc. Time is your ally in the investment world. Long-term investments through power of compounding, where your returns generate additional returns over time, exponentially increase the wealth potential. Effectively leveraging mutual funds involves optimizing the features of mutual fund schemes to maximize the returns. Take, for instance, the investor has defined goals, return expectations, and risk tolerance, and select funds accordingly. Suppose he starts a systematic investment plan with 5,000 every month in an equity fund. With fluctuations in the market, he buys more units when the NAV or the net asset value is low and buys less units when the NAV is high. This strategy is known as rupee cost averaging, which mitigates the impact of short term market volatility and making his investment resilient. Regular monitoring of portfolio, say in 3 months, 6 months, that it stays in tune with the evolving goals and the market dynamics. So another thing, for example, for a retirement planning, we consider two investors A and B working in the same company, same age, like 30. Both want to invest for retirement, but A starts immediately at 30, 2,000 rupees per month, planning to invest till his age of 60. And investor B is investing 4,000 rupees and start his investment only at 45. At the end of their planning period, like when they reach 60, both investing 7,20,000. Here, the investment period is different. A invests for 30 years and B invests only for 15 years. At their age of 60, the corpus A has in his hand is 2.7 times of B. A has 46 lakhs and B has only 17 lakhs. What has worked in A's favor here is the investment period, which is double than B. B has invested only for 15 years and A has invested for 30 years, even though amount is only half. Here, the compounding effect of investment in the market we really can be known. Like 30 years, even though the amount is off, half of B, A could generate 2.7 times of assets of B. Here we have not considered the effect of inflation and taxes or anything in between. This is for simplicity reasons. We said the long-term investment always generate more returns due to compounding. Compounding is synonymous with time. You have more time in the market, more chances of getting better returns than the short term. Okay. So there are the benefit of compounding in mutual fund schemes may increase in these two scenarios. One, if you start saving and investing at very early stage, immediately after job, maybe. And if you stay invested for a long time. As a mutual fund investor, you probably get better returns by investing through a systematic investment plan. You can allocate each SIP for different financial goals and let compounding benefit work its magic.
Okay. Suppose I have a goal of reaching certain amount. You can say I have a goal of having some 1 crore rupees of Indian rupees at my age of 50. What should be my strategy on this SIP or the investment?
Strategic investment planning is the key. The 15-15-15 rule of mutual funds proves to be the best formula here. In order to achieve your goal of 1 crore, you have to invest 15,000 rupees monthly through a SIP for 15 years in an equity mutual fund which has the potential to give 15% annual return. Several equity funds in the high growth, small and mid cap categories have achieved this return and much more in the recent years, making it is a feasible outcome for you. The investor can hit 1 crore mark through consistent adherence to this strategy. With a total capital outlay of Indian rupees 27 lakhs for the 15 years, the projected long-term capital gain of like 74.5 lakhs. After 15 years, you will have 1 crore, 1 lakh and 52,000. Start small, grow big. Beauty of long-term investment is you do not require a massive amount to start with. Starting with small amounts and investing consistently allows your investment to grow steadily over time. Remember, time is on your side. That earlier you start, the more time your money has to grow.
That was a wonderful advice. Complete my target. From your experience, what is your piece of advice for the investors in mutual fund?
See, building wealth is neither based on get rich quick, nor is it based on luck. It requires a lot of time, patience, consistency, and prudent decisions. To help accelerate your wealth building journey through mutual funds, I have some bullet points. Basically, start early. Sooner the investor starts, the better. Since the money gets more time to grow, it's a slow and steady process. Invest consistently. Develop a habit of regular investments through SIP or any other means to build discipline and to reap the benefit of rupee cost average. Rupee cost averaging, as I explained earlier, it is like when the market is high, you get low units. When the market is low, you get more units. Overall, the investor will be getting more units compared to the lump sum investment. Invest consistently is the very important point investor has to keep in mind to make big money in the market. And another point is match risk return profile with investment choice. The investor has to assess his comfort with potential market fluctuations to higher growth prospects or stability with reasonable returns and choose the funds accordingly. The next point is diversify. Do not put all your eggs in one basket. Spread your investments across different types of funds so as to form a well-rounded portfolio across different asset classes and sectors. It helps to mitigate the losses if a particular sector or particular industry is underperforming in the market. Then stay invested and avoid market timing. Be patient and disciplined and resist the urge of jumping in and out of the market based on the short-term market fluctuations or market volatility. Long-term investment is all about riding out the ups and downs of the stock market. Then stay informed and do not overreact. Follow the general market trends and the performance of the mutual fund schemes which is in the portfolio. But do not allow market volatility or market fluctuations create anxiety. Stick to a well-rounded long-term investment strategy and avoid impulsive decisions based on short-term market behavior. Seek professional guidance. In case the investor is finding it difficult to navigating the mutual fund landscape, they can always take the advice of mutual fund distributors.
Speaking of professional guidance, from your stint as a director of Panai Maram Fintech, what do you think is the role of mutual fund distributors in enabling investors to build wealth?
Mutual fund distributors, we help assessing the risk return profile of our investors and suggest investment plan that aligns with their goals by suggesting suitable mutual fund schemes with excellent track record and experienced fund managers. Our goal-centric approach by tailoring their investments to specific objectives increases the likelihood of our investors achieving their wealth creation milestones. We take our investors through all the documentation process, starting with KYC, knowing our customer. If they are already KYC compliant, we start the investment process immediately, or we do the documentation work for them to be KYC compliant. And initiate the investment process either by SIP or lump sum and guide them through the entire process and guide them also to monitor investments on a daily basis if they want. And we also monitor their portfolio on their behalf and also advise them whether stick to a particular investment scheme or change to another. We started our company in a small city called Maram in Tirunelveli district, where people have limited knowledge about the stock market and limited market access. Our aim is to instill an investment culture among the local people who are more into deploying their money in chip funds, which are not coming under the ambit of the regulation. The prospect for mutual fund as an avenue for investment looking right, we hope to bring in more of small investors to build their wealth through small but consistent contributions to the investment. We are the nice little gardener who takes care of the garden with the investors as flourishing plants that are on it. The road to wealth creation is a marathon. It's not a sprint or a 100-meter dash, and requires discipline, patience, and informed decision making to achieve the financial goals or the financial objectives of the long-term wealth creation. Mutual funds stand out as a perfect avenue for long-term wealth creation. It is the experience of me and my opinion for all the investors.
Thank you, sir. It was a wonderful talking to you, sir. Thanks for your time, for sharing valuable insights about the mutual funds to our audience. We hope this podcast helped you to gain good knowledge on mutual funds. The valuable insights shared by our guests could reshape your investment approach on the mutual funds. As a token of our appreciations, we would like to give you a small memento to Mr. P.P.MUTHU. Our Tamil Nadu Engineers Forum President, Mr. Raja, is here to present the memento to Mr. P.P.MUTHU.
So it was nice watching live. Live means real life rather than others watching in the live telecast. And it was a wonderful session. And I'm proud to give you this memento not only as a president, but I'm a proud client for Fintech. So with this, I'd like to present you the memento. Thank you, sir.
Thank you. Thank you very much. Yes. Thank you for the opportunity for us to present here.
Fine, sir. Actually, people are maybe people are thinking that what is relevant with the technical and the mutual. All the technicals, what we are putting, what we are emphasizing, and what we are developing, all for the finance only. So this is more important than technical. Thank you.
Thank you. Right. Thank you. Right.
Thank you. Thank you. Okay.